So today you have a choice of investing in FMCG sector where mid-cap FMCG companies are trading at a valuation which is higher than large-cap pharma companies.
So go down the ladder there.
Now, can I focus on mid-cap pharma companies and large-cap pharma companies which generate similar ROEs and which have similar defensive nature vis-a-vis FMCG company which looks a little bit more expensive. And on the other hand, I also keep some portfolio in those sectors or those areas where they have been beaten down, the debt is limited, and the projects are about to begin, which can generate positive cash flow. Even if that cash flow keeps on repaying debt, the equity value will keep on increasing.
Whereas it's easy to understand an FMCG company, focus on return on equity, focus on return on capital. It's getting increasingly difficult to understand a pharma company. Look at the Indian pharma sector. Two ends of the spectrum. One side you've got Ranbaxy and Wockhardt, the other side you've got Sun Pharma and Lupin. How does one figure out which way to lean within the pharma space?
See, definitely pharma is far more complex than the FMCG companies, and especially when we are looking to, sell more and more into global markets, our companies are becoming far more global in nature. So one simple solution is that why bet only on just one or two companies? Why not buy a basket of companies? Some will do well, some will not do well. The second thing is to look at the long-term track record of the companies in terms of how they have built their businesses. So there are some guys who have become supplier to the global manufacturers, global companies, and they're making reasonable profit and there's a limited risk. There are some companies which are saying that, look, I will not only manufacture the product, but I will also go and distribute the product, and I'll take time to build that brand, build that distribution network. Now, in such cases, if you are too early into investments, probably your returns will be deferred and delayed. But if you are entering where companies have spent some amount of time and cost in building distribution network, and they are probably 6 or 12 months away to capitalize on the same, probably that's the sweet spot to buy into such kind of companies. So look at the track record, try to figure out what the business model of the company is, and third, try to be diversified into this portfolio. Why go for just one or two companies and why not 6 or 8 companies? The other interesting thing in pharma companies which people should remember is that this is probably one of the few sectors where if the companies don't work and the promoters sell out, as an investor you'll still end up making money.
Yeah, quite true. The last time when we spoke about Infosys, you told me that, look, a quality franchise like Infosys is available below 2,300. I would be using the stock with both. I would be buying the stock with both my hands. The stock is at 3,000 now. Are you still buying it with both your hands?
See, definitely at that price, I could be adventurous enough in advising, and it's normally not my characteristics to push something with such a aggressiveness. But that price, it was a blind buy, and especially in a volatile market, that was a great place to be in. Now at 3,000, that upside is gone. Will this company still deliver return? The answer is yes. But will it deliver return with so much of certainty in such a short period of time? No. That big move has occurred. Now one will have to wait in the company to get the return. Now market's not going to give you the return on Infosys, it's the company which is going to give the return on Infosys. So one should buy because rupee depreciation will benefit company, change in the management will benefit the company, but the returns will now come not like, one-time gain. It will come over a period of time.
What to your mind is really driving large cap IT? Rupee depreciation or business prospects?
I think both the things are driving. In certain large cap IT companies, it's the growth momentum which is surprising the market. Even on that size and scale, the growth is still coming ahead of market expectation, and valuations are not too expensive. In certain IT companies, it's the prospect of turnaround, where while the growth has been subdued, but now with the recent changes in the management, people are expecting that growth will come back. The third IT companies which could be a great investment is where consolidation is occurring. And with the consolidation, economies of scale will come into play, and the valuations are quite comparable. So IT sector as a whole is benefiting from the currency depreciation, which will support them on the margin side. And second, while there are concerns on the global side in terms of immigration bill or in terms of BFSI space being slowing down, overall Indian IT is still in a sweet spot. And hopefully, coupled with the valuation vis-a-vis relative to the other sectors and market, this sector provides a respite in today's turbulent, volatile market.
Would you be using the current decline in private banks to your advantage to load up some quality private banks, banks which you always wanted to buy in the past, but you never had the luxury because of expensive valuations? A lot of good stuff in the private banking space has corrected 10, 15, even 20%.
Definitely. We are overweight private banking, and our whole call is that market is pricing in as if this liquidity tightening measures are going to continue forever, as if this volatility in the fixed income market is going to continue forever. Our view is that the liquidity tightening measures are to support rupee volatility, to reduce rupee volatility, not to alter the direction of rupee. Second, these are all short-term measures, and over a period of time it will start stabilizing. So market will then start pricing in the stable currency, lower yields, and better liquidity. That delta can be captured by private sector banks very easily.
So you are not of the view that it's time to kiss goodbye to banks?
Definitely not the private sector banks. And look at the valuation of NBFC sector, where the business models have been stable, growth is predictable. They are all trading at a reasonably high valuation to the private sector banks as well as public sector banks. My feeling is that private sector banks eventually will transit towards the NBFC valuations.
In the past, you've argued that why should one not ignore Indian two-wheeler stocks? Bajaj Auto is at 2,000, Hero MotoCorp is at 1,800 because of good monsoon and the fact that government spending will increase. Rural spending is only poised to go higher. Is it good time to revisit two-wheelers? Four-wheelers are getting extremely competitive. Two-wheelers, I guess, all the competition is already in the system.
I think in the automobile space, we have seen that whenever liquidity is there in the banking system, invariably it results into better demand for automobiles over a 3 to 6 months period. Now, liquidity did improve between April to June period, and then July onwards it has become tighter. So we will still see the benefit of April to June improvement of liquidity and good monsoon and election into two-wheeler demand over next 6 to 8 months. From a valuation point of view, two-wheeler stocks are trading at average valuations. They are not at premium to the market. They are not at premium to their historical average. So they don't become a screaming buy, but at the same time, in a volatile market like today where you're looking at non-capital dilution, some amount of certainty or growth and reasonable valuation, two-wheeler stocks fit that bill perfectly.
And something like Bajaj Auto will also benefit because of a weak rupee.
Definitely. All these auto companies of India are now focused on exports, and weaker currency does give them certain benefits.
So to your mind at the current juncture, which are some of the key groups or key stocks or key sectors where valuations are reasonable and growth is also predictable?
So I'll divide it in following parts. One, I'll try to build a portfolio around companies which are engaged in exports. The weaker rupee will benefit them either on the growth side or in terms of margin side. The second portfolio to be constructed is about companies where there is potential sellout opportunity. Either these companies are highly leveraged and hence promoter would like to sell out, or there is no succession in the place and hence promoter would like to sell out, or there is a consolidation waiting to happen in the market, and the trigger for that consolidation will be foreign players coming and taking over 2, 3, 4 companies.
But this is like a lottery.
This is like a lottery, but if you build enough portfolio, then you will probably see a 6-monthly lottery coming.
Okay.
And that's something which is not worth missing. And this stigma attached to selling out is now seems to be behind. A lot of activity is happening in the unlisted space, and my feeling is that the same will be transferred into listed space over a period of time. Clearly, promoters who don't have succession has to sell out. Promoters who are hugely leveraged, they need some respite, and they wouldn't mind knocking off 1 or 2 portion of their business in order to ensure that the leverage comes down. And the third is related to consolidation of market. Clearly, economies of scale are required. And today, because the financing or the balance sheet of the Indian Inc. is not in that good shape, this consolidation has to be driven by the foreign players. So this is one portfolio which is lottery in nature, but then you could probably have lottery every 6 months. So this is one portfolio which is worth building.
So you will not focus on FMCG, consumer or consumption-oriented stocks?
In FMCG, one can look selectively where there is little bit of value left, And when I'm talking about value, it's quite a euphemism because everything is expensive, and within that we are trying to become less expensive. But I still remember in 2000, one research report which I had read, which justified investing in a mid-cap IT company at 60 times valuation because large-cap IT was running at 100 times. Clearly, one should not repeat that mistake in FMCG companies, because if large-cap companies running at X valuation, that doesn't make mid-cap company trading at 30-40% discount to that a value buy.